Today we're taking a long walk through history back to the late 1800s. The goal is simple. Zoom out far enough to see where we actually are in the current bull cycle. By the second half of this video, I am going to ask a question that most people aren't ready to ask yet. And the answer might actually confirm the very thing you're afraid of. Right now, the noise is very loud. AI bubble talk, Japan stress, liquidity concerns, debt spirals. Every cycle has its version of fear. So instead of staring at the last 5 or 10 years, I want to zoom out more than a century and let market structure do the talking. SPY only goes back to 1959. So for this exercise, we're going to use Dow Jones. That gives us over 100 years of history starting from 1897. So as you can see on these charts, I have marked consolidations and bear market phases in red and expansion phases of bull markets in green. Direction isn't the only thing I want to focus on today, so make sure you understand the time aspect of it as well. How long the market stayed in each phase is very important to understand. So from 1897 to 1924, the Dow went essentially nowhere. That's a 27 years of consolidation period. You can see clear support, clear resistance, endless back and forth. From the lows to the highs of that range, price still moved about 280+%, but structurally the market went sideways for nearly 3 decades. Then in 1925, the breakout finally happened. The market ran for about 5 years and gained a little over 300% on this particular move, and finally that ended with the 1929 crash, which brought us below where we first started. And after that crash, the Dow stayed below its prior high for roughly 25 years. Think about that. An entire generation never saw new all-time highs. In fact, in middle of recovering from this bubble pop, we went into physical tightening, which dropped the market again, and this was the Great Depression era, and that is a very long and painful road of our history. The next real expansion didn't begin until 1954, and once we broke out above the prior highs, the bull market ran for about 11 years, and at that time we printed a little over 150% gains on this bull run. Now this is where things change a little bit. In the last bull run, we barely saw any drawdowns, but this time around there was one major correction, around 28%. Painful, but it was contained and the market continued higher. This was the first time that in a bull market we saw a 28% drawdown. After that, from 1965 to 1982, the market consolidated again, another long frustrating range. Then came the 1982 breakout, and this one was different. The Dow Jones went up 1,000% plus across nearly 2 decades. But there was something different this time. This ride was a lot more rougher, more drawdowns, deeper corrections than the past. There was a little more volatility, but yet the trend stayed intact for many years. In the last bull run, we saw one drawdown of about 28%. In this case scenario, we saw one for about 38% plus. And then we saw another one for about 20% plus. And right before that, we also saw, let's see, this one is about 15%. I'm not going to take this into account, but 38% and 20% pullback. And what I'm trying to emphasize here is that as the market grew stronger and matured with time, the drawdowns and pullbacks got larger and larger. There was more emotions involved, not just data and fundamentals. And we all know what comes after that. The cycle ended with the dot-com collapse, followed by the 2008 financial crisis, a double bottom across 13 years, which is why they're boxed together here. And this is where things get interesting, and I'm getting to my question in just a few minutes. First, let me welcome you to the 21st century. The market structure changes again. We go into this 4-year expansion range from 2013 to 2017, followed by a 3-year consolidation and correction, then a 1-year COVID surge, followed by another year-long crash, and then prices resume higher. We go into this tariff tantrum, get another 20% drop, and then here we are today approaching 50,000 points. And that brings us to the core question of this video, and the question I wanted to ask you earlier. Did the period for bull markets and bear markets shorten over time, unlike how it was back in the days where the bull markets lasted 5 years, 11 years, 13, 18 years, and so did bear markets, 16 years, 25, the Depression era? Or is there something different that we're not seeing, which is, if I delete all of this data, could it be that this entire run up was one long bull market? Could it be that from 2013 to who knows how long for this bull run will continue, and these drawdowns weren't bear markets and they were just corrections along the way. Because there is evidence that if you look at it historically, the drawdowns have only increased. The first bull market barely had any pullbacks. The second one had larger drawdowns. The second, third time around, we had a lot larger corrections. We started this bull run and got this 18% correction during 2018 government shutdown. Then we got about a 38-40% drawdown due to COVID, then another 20% drop due to the fiscal tightening. And this all makes me wonder, what if we have been in a bull run this entire time? And obviously this is driven by the liquidity injected into the markets, and I understand that. But what if what comes after this is another long drawn bear market that we have to sit through for another, I don't know, a decade or decade and a half? And one of the biggest reasons this is a possibility is because AI capex spend is going higher and higher, and the revenues for AI aren't showing on the balance sheet. Now, I'm sure if you follow earnings, you do see that the Mag 7 are producing pretty good earnings, but most of that is just the prior business. Nothing in there shows that the AI has helped produce more earnings, especially compared to the amount of money they're spending to build infrastructures for it. We also know that there is enough data to show that we do not have enough energy in US to run these data centers that are being built. So overall, I do want to be positive. I want to be ambitious. I want to say that yes, AI will bring productivity and produce better results, better earnings, and the market will continue higher. But I just wanted to share this chart with you. I wanted to go through the historical data to share with you that it is possible that we go into a long drawdown period where, just like the dot-com bubble, we do not come back to prior highs for a long period of time. I personally truly don't know the answer to this question, and it would be great if you have any opinions. Feel free to add to the comments. And before I close, I will say that most of these major crashes align with some fiscal tightening, and in today's world, I do not foresee that just yet, because we still have room for rate cuts. We still have room for liquidity injections in the market. So this bubble can continue higher. In fact, I am very bullish on the second half of 2026. I do expect some kind of correction in the first few months of 2026, but down the road, I'm pretty bullish on the year. But yeah, I mean, if you understand what I'm talking about here, this is a very crazy concept. Even if we go higher from here and then go into this crazy bull market, we already know that ETF inflows are at all-time highs. Everybody is investing into the markets. People who couldn't make money during COVID and after COVID, they decided to monthly invest into the WU ETFs or any other ETFs to get exposure into the markets. So imagine a generation of buyers who get trapped into a 5 or 10 years of bear market or sideways consolidation. I don't know if we have it in us to go through that. We have Warren Buffett sitting on hundreds of billions of dollars in cash, and before retiring, he mentioned that he doesn't see opportunities to invest right now, which is crazy coming from Warren Buffett. So then maybe it is time for us to take a step back, think about this, and think what our next 10 years could look like if this comes to an end. With that being said, I hope you like the content. Please leave a like, subscribe to the channel, and I will catch you on the next one.